Hello, YouTube. Justin here. And in this video, we're going to talk about three things specifically. The first thing is going to be the incredible snapback that we got into the later part of the week with that gap down pump up. The second thing we're going to talk about is why I think this is a trap and the reason why we have to be particularly careful this week. And then the third thing is going to be if the leaders of yesterday are still the leaders of tomorrow. So stay tuned. In this video, we're going to go through all of this. And if you're enjoying the video at any time, please destroy that thumbs up and drop me a comment. I would personally really appreciate it. All right, so the first thing I want to do is going to be a little bit different than last weekend. I'm going to go through and actually just provide some levels here to just show what I am looking at here on SPY, which is the stock market's best gauge for what is happening. I'm going to go ahead and just explain what I'm noticing here, and then I'm going to delete everything and show you what it would take for me to be wrong, because right now I think this is a massive trap. So just looking here, the first thing that we have is we have a dominant head and shoulders pattern. We can note that here by just looking at the head and shoulders pattern. So until we actually cross back above about 454 on SPY, we are technically bearish. You're going to also note that I have an arrow right here, and this arrow was pointing at this upper wick. So I'm going to explain in a minute why that matters. And what I'm going to do next here is just have a look at the volume. So for me, the reason why I think this might be a trap is because if we saw, again, this is a lot more volume than we saw this week. If people loved the price at 430 all the way down to 420, why the hell are they not buying more aggressively when we went all the way down to 411? That's my biggest concern. And I think that the violent snapback that we got is hard to deny. But what I think it is doing as well is it is providing some false hope for people. We have to keep in mind that some of the most violent bounces come in a bear market. And this last one from the last 2 days is so strong that I think a lot of people might have their blinders on. So let's have a look here and see why it might be a trap and the telltale sign I'll be looking for. I'm looking at these two levels right here specifically. We're looking at about 460, and then we're looking here at about 448. So on the first move down, we snapped back. We had a violent move higher, and we closed near the high of the week. We can see that here signified by us closing right near the high of the candle over the 50 moving average. What did we do the next week? Bullish continuation, but where we stalled out was right here at a lower high versus where we started the plunge. So we started the plunge right here. We dead cat bounce all the way back up, form a lower high, and then reject. So what would that mean for me on this most recent move right here? I'm watching this level right here, and that high is going to be 448.06, which happens to also correspond with our 44892 low, which we put in November. So this level right here is going to be the impenetrable fortress that I think we're going to stall out at. Here's what I think is going to happen. I think we could snap back, test this area, and then come back down and fail. I don't know if that happens in one candle or two, but if you are bullish, here is my advice for you. Wait until we actually close a weekly candle back above, whether it is below 448 or above. We should come back down and retest this 50 MA. And on that 50 MA test, if we're really going to curl back up to all-time highs, that is where you want to get in. So at a very high level, that is what it would take for me to invalidate this pattern and to start making momentum up towards that 454 area. What I'm going to do now is talk about the gap down pump up that we got and we were expecting going into this week. So if the bulls are truly in control, we should not look back from here. We should blow through all the resistance. So again, we got that gap down pump up. And here's something else that might tell me that I'm wrong. We have two things to look at here. So again, a bullish bet for how much? $200 million. We had an investor who was just making a very bullish bet in the S&P 500 for the last 3 days. He doubled down on his bet today that it's going higher. Again, it's real money, and it's a bet for $200 million. That is not couch cushion money for me, and these are real big numbers. The investor bought 65,000 call spreads that expire every Friday between March 4 and March 25, basically meaning starting next week all the way through to March 25th. The biggest bet was for the 30th call spread that expire on March 18th, right after the Fed meeting. And this is going to be on monthly OPEX. The reason why it matters a lot is because of this lower number right here. The break even, where he gets his $200 million back. Price suggests the investor believes the S&P will be at least as high as 4460 at that point. So the reason why this matters is because I think I laid it out here. So the 200 DMA and the 50 weekly moving average. So in a second here, we're going to look at the charts. But what I mentioned is that if we are below the long-term price on the daily chart and below the short-term price on the weekly chart, what are we? We're trending down. It's not rocket science. If you can't draw trend lines, just look at the moving averages. The 200 is going to be the long-term and the 50 is going to be the short-term. So as we have a look here, why would it matter on that 4 to 4.6 area on SPY, the equivalent of 4460 on SPX? Because right here, the yellow line, which you can see, which is just above the candle close, is sitting here at 439 and should be about 440 into next week. When we flip over here to our daily chart, we can note that it is here at 44499. What does that mean? It means that if we're going to close above 4460 sometime between March 4 and March 25, we are going to be back above the 200 and back above the 50 weekly moving average, which would mean we are no longer technically trending down and we would be potentially snapping back. Next thing I want to point out here is that we also had maximum fear going into last week. So we had extreme fear on the previous close, which is what I said I wanted as well. I wanted that extreme fear. I wanted the gap down pump up, and we fell back into only fear here. So if this is the true reversal, we should not be looking back, and we should just pump from here. So now we're going to talk about why Justin is bearish. So this is the reason why. In a moment here, we're going to talk about the key dates for this week ahead, but this chart goes back to the bear market of 2022 explained video that we put out about, I don't know, like a month and a half ago. It might be longer, it might be shorter, I forget. So this one is not terribly difficult to understand. The Fed's balance sheet is directly correlated to the S&P 500. So because Jerome Powell has a 2-day testimony this week, what he says is going to really matter as we get that payroll Friday coming in on Friday and then CPI next week before the FOMC meeting. If the Fed stops buying, even if it's only going sideways, what happens to the market? Sideways to down. They unwind a little bit, market tanks. They buy, market rips higher. So as everyone is contemplating what is going to happen to interest rates, I'm actually more focused on the balance sheet and also on interest rates. And the reason why is because technically we are still providing accommodation all the way through to March. The Fed is technically still doing quantitative easing by buying $30 billion in bonds every single month. So if we are not fighting the Fed and they're telling us we're going to stop buying, we're on the highway, we're going 100 miles an hour, and then we're going to slam it into reverse, what's going to happen? Well, we should go down if we're not fighting the Fed. So looking at this chart here again, which comes from that bear market of 2022 explained, in my opinion, everyone thinks that the market is not done expanding. With all due respect, it's gone up 600%. And as we look at the chart here, that 1980s date is going to come back and play a little bit later in the video. But 149 months of expansion, 600% before we had the lost decade. And then what do we have here? From roughly 2008 to where we are now, 154 months of expansion, 600%. And we are off the highs now. So this is where I think that if the bears are in control, they're starting to see a little bit of movement. The reason why I also don't think we've bottomed is because, frankly, I don't think we've cut deep enough. On a closing basis on this week and on every other week, we've not actually closed below 432. So if we have a look here at SPY in the weekly, there's not a single week where we close below. Closes 434, closes 441, closes 437. So even though we've closed below 432 on a daily closing basis, we have yet to close in correction territory on a weekly closing basis. So what this tells me is that if Jerome wanted to give the Powell put, why the hell would he give a Powell put when we're not even in correction territory? That seems silly. And I don't think that there is any reason for him to think that now is the time to save the market. The Powell put has been identified at being at roughly 370, 380. And the reason why that matters is because that is basically where we were going back to the 2020 high. So if we puke up all of 2021 gains, we flatline here at roughly 370, 380. That is where the big guys are looking for the Powell put. Again, why would Jerome flip to dovish now when we're less than 10% off the high? Inflation is running away. And he's going to be in this job for 4 years. He's got a long road ahead of him. All right, so we're going to move forward now to, I don't know why it keeps jumping around here. It's pretty annoying that it does that in terms of the slides. I don't know why it's doing that. Anyways, looking at the key dates for this next week. So Tuesday, Wednesday, Thursday are the big days. Friday also matters, but bold means it is more important. So on Tuesday the 1st, we have the State of the Union address from Joe Biden. On the 2nd, we got Jerome Powell testifying. On the 3rd, which is Thursday, we have Jerome Powell testifying again. And then on Friday, we got Payroll Friday. Following week, we've got CPI, FOMC meeting, and OPEX. So what I want to look at here is just the dates where these key events start playing out. So when we have a look here on the monthly chart for the S&P, what we can notice that we're going to be opening up a new candle. And we can note here that we've had three consecutive candles or months of dip buying. Where we close this month out and where we open in the next month is going to really, really, really matter. We're going to look at a Dragonfly Doji pattern in a little bit here. And just want to be aware that as we close the month out and open the new one, if this is all dip buying, which wants to go green, we should destroy that high of the month at 458 and continue to go back up to all-time highs. So that's the takeaway here. Biggest events are likely going to be on Wednesday as we start. And we start to hear about the tone that Jerome Powell is going to be striking when he's talking about everything I mentioned in the other video. Meaning inflation, 50 basis point hike, balance sheet runoff, and then the potential for geopolitical tension. All right, so next thing here is why we would be bullish and why we would be bearish. So if we are bullish, the bottom is in. We cannot afford to have another month of dip buying. We have to push up from here. Peak hawkishness and geopolitics. So I think we've hit peak geopolitics tension. Why? Well, we saw that violent, one of the best two-day gains I have seen trading in more than 15 years. And peak hawkishness, where we were looking for potentially 7 or 8 rate hikes only last week. So if Jerome Powell is going to dial it back, we're going to hear about that this week. In terms of the bear case, again, the wheels are in motion. I showed you the chart, 600%. It's a very sobering when you zoom out, not to daily chart, not to the weekly, not to the monthly, but to a multi-decade pattern, in my opinion as well. In terms of the inflation narrative, Team Transitory got kicked in the balls. They were wrong. They were wrong. They were wrong. And now with the potential for people seeing that oil's now above 100, people are like, never going to hit 100. It's over 100. And we're seeing that tension is ratcheting up. Inflation is real. Even the PCE, the Fed's favorite gauge, is at the highest level since 1983. So the inflation narrative really matters now. And the credibility matters for the Fed as well. Because if they don't want the people to discount what the Fed is saying and still, right, don't fight the Fed, they have to be right. Because people like making money. And at a certain point, people are just going to pull out and rather be on the sidelines than hope and pray that we're not going to get any more downside. Looking at surprises, geopolitics, again, the Fed report, basically meaning all of the testimony from Jerome, and then the bear put flow on SPY and QQQ. So I just want to make a note here that I think I want to start moving forward to a different section. And in here, what I want to talk about is going to be this right here, where history, those who fail to learn from history are doomed to repeat it, from Winston Churchill. There's different versions of this quote. Again, those who don't understand history are doomed to repeat it, and different versions of it, right? So the reason why I want to talk about this is because we just talked about the bear catalysts. And as we look forward to here, I want you to listen to this with a critical mind. Listen to what the definition of stagflation is and ask yourself if that is what you see happening in the real economy right now. In economics, stagflation or recession inflation, again, keyword there being recession, is a situation in which the inflation rate is high, the economic growth rate slows, and unemployment remains steadily high. It presents a dilemma for economic policy since action intended to lower inflation may exacerbate unemployment. And as we look forward here too, stagflation, again, stagflation occurred in the 1970s as a result of monetary and fiscal policies and an oil embargo. So why does that matter? What are we facing right now? We're facing monetary and fiscal policy issues, and we're seeing oil back above $100 because of tension in Russia and Ukraine. So moving forward to the next section here, and the reason why I think this is important is because of the slide we looked at right here, which I'll jump back to for a second. This one right here, where we're talking about the Fed's balance sheet versus the S&P 500. And now, as we look back to This, which is from, I believe, on the 19th, which is going to be earlier this week. If the Fed wants to reduce their balance sheet, I don't know that they'll be able to. So again, recapping the proceeds of a conference held by the group on February 17th. This is before the geopolitical tension. The BPI said attendees doubted that the standing reverse repo facility, or the SRF, would be free of stigma. If the SRF does not work as intended, the Fed may meet resistance, shrinking its portfolio of securities as scarcity in the market to reserves materializes sooner than expected. And, as happened in 2018, requiring the Fed to stop redemptions and instead raise the federal funds rate more aggressively. If you're listening to what I'm saying here, it means that the case for the 50 basis point hike is stronger than it's seen before. If we're going to be going into reverse, which is quantitative tightening, and there's no one who wants to buy this crap because they know it's not worth anything, what's the Fed going to have to do to cool inflation? They're going to have to get more aggressive on raising rates. And because Jerome Powell has been MIA and has not said anything in the last while, when he gives not his prepared remarks, but his Q&A and what he says specifically about inflation and the rate of it, the 50 basis point hike, what he sees as the outlook, and then also the potential for geopolitical tension for him to skew back dovish, whatever we hear is going to really matter in terms of the feedback loop when we hit Friday. All right, so there we go, right? Talking about all this bearish stuff. All right, moving forward now. So what I want to look at now is going to be the 50 weekly moving average and the 200 DMA and the 50 weekly moving average, because why does it keep doing that? It's really, why is it doing that? All right. Pretty frustrating. I don't know why it keeps jumping around to different slides. Anyway, Dragonfly Doji. So what I want to do now is actually jump forward to, I don't know why it keeps doing that. All right. Really, really annoying. Month end rebalancing. So we also have month end rebalancing happening at the last day of the month, which is going to be Monday, just before we have all of the Fed talk. And we also have Joe Biden giving the State of the Union address. So if we look at the charts now, we ask ourselves, if there is going to be a rebalancing happening, the people who are going to be buying and the people who are going to be selling, would they be motivated to try to manipulate the charts to push them one way or the other to force someone to buy something they don't want? And also, who are the leaders of yesterday, and are they still the leaders of today? So we're going to move forward here to our bull section. And this is where, if the bulls are going to be truly in control, we're going to look at a few charts here to go bottom up, which means we're going to look at what drives the market and then come back to a higher level and look at the S&P as a whole. So the first thing I want to talk about here is the gap down pump up, which is the potential for the reversal. So far, we've got a monster dead cat bounce, but we failed to make that higher high on the weekly, which means that as of right now, it is still on the bulls to break us bullish. Next thing I want to look at is going to be QQQ and the trillion-dollar companies. But before we do that, I just want for people to understand what a Dragonfly Doji pattern is. And the perfect example is this right here on Apple, where we can see that we open and close within 1 cent of each other. We open at 164.86. We close at 164.85. And what does it form? Roughly a T with a massive lower wick. So a Dragonfly Doji is defined by a type of candlestick pattern that can signal a potential reversal in price to the downside or upside, depending on the past price action. It's formed when an asset's high, open, and close prices are the same. The long lower shadow suggests that there was aggressive selling during the period of the candle, but since the price closed near the open, it shows that buyers were able to absorb the selling and push the price back up. We got a couple of key takeaways here. Then I'll go through some examples. So the key takeaways are this: a Dragonfly Doji can occur after a price rise or a price decline. The open, high, and close prices match each other, and the low of the period is significantly lower than the former three. This creates a T shape. The T shape we can see right here on Apple, right, forms a T. And then the appearance of a Dragonfly Doji after a price advance warns of a potential price decline. A move lower on the next candle provides confirmation. A Dragonfly Doji after a price decline warns the price may rise. If the next candle rises, that provided confirmation. Candlestick traders typically wait for the confirmation candle before acting on the Dragonfly Doji. So let's go back here and I'll show my face to explain this. So if you're listening to what it says, wait for the next candle. What is that? It's going to be the weekly. So we have Dragonfly Doji patterns on almost everything. I'm going to focus on the ETFs a little bit later, but we're going to talk about, actually, let's go over to SPY first here, just to give an example. So let's look at SPY. Again, this is a hammer. So it's close. Let's actually go back to here. So it's close to a Dragonfly, but it's actually a hammer. But we're closing just below the 50 weekly moving average. As we have a look at things like NYSE, we have a look at things like, what is it, like DIA. What do we have? They're basically all Dragonfly Dojis, but below the 50 MA. So this is truly a reversal. We have to not only hold up here, we have to break and close back above the 50 moving average, which means we need a bullish reaction to Biden and Jerome combined by Friday close. So now let's go back and have a look at what drives the market underlying. So we got Apple here, and we went through these before. So I'm going to zoom out a little bit here. We're still trending up. We almost bounced off the 50 MA, and we're holding up here. So check above the 50 and not all that bearish, roughly holding up here at about 165. Next largest stock in stock in the market is going to be Microsoft. Here we can see that we got a lower wick as well, a massive hammer here. What do we get? Blew through the 50 MA, and it is engulfing part of the previous bars. So again, above the 50 MA, check. It reversed back above. So that's 2 for 2 now. Now we're going to go to the third biggest company, Google. Same thing. Close below the 50, double bottom with a massive lower wick. Close above the 50 MA. That is now 3 for 3. The next biggest company is going to be, what is the next biggest one here? I know I had them all drawn up. Let me have a look and see what this means specifically, because I got them in order here. Apple, Microsoft, Amazon. Let's have a look at Amazon. Amazon is below. So again, massive hammer here. It's roughly at the close of the previous bar. It's closing up by about 1%. And still below the 50 in a downtrend. So that is one, which is still below. Next one we're going to look at here is going to be Tesla. And Tesla appears to be pretty strong. And the reason I say that is because it actually massively overshot to test its previous top back to here at about 713, 718. And we're closing back above the yellow line, which is going to be that 50 MA. So even though it's down 5.5% on the week, it's technically closing back above 803.87, which is that 50 weekly moving average. Next one here is going to be Facebook. Facebook is below. It's way below. It's got a lower low and a lower high. So again, does not look all that pretty. And the last one here is going to be NVIDIA. So NVIDIA bounced off the 50 and it is right back to where it was with a hammer. So now we can see that what drives the market on an underlying basis is potentially showing us some reversal signs. And the reason why is because we got two that close below the 50 MA. That's going to be Facebook, which is already way below, and Amazon. And then we've got every other one back above. Apple, Microsoft, Google, NVIDIA, and what was the last one? Google. So all those ones closed above, which means if these are still the leaders, we have to see them lead and do what? They have to drag the QQQ kicking and screaming back above the 50 MA. We cannot afford to stall out anymore. We have to break this trend and blow through this 50 MA, which is at about 361, 362 for next week. So if we can't do that, in my opinion, it's a trap. Why? Because they're just taking advantage of the liquidity. And there is not enough volume for me to say that people are aggressively buying the dip here. It feels like a trap. So now let's move forward and look at the next section here. Now we got the bear case. So again, this is where some people might not like what I'm going to say, but hopefully you heard the warning in the last couple of months, last couple of weeks, and you were able to at least avoid some pain. Because as we pointed out before, for every 1% decline, you got to make an extra 10% to make it back up. And if you lose 50% of your account, you have to double to get it back. So now, again, like I mentioned before, we got bear targets here. So I believe the Powell put will be found somewhere in the high 300s, 370, 380, 390. I don't know, somewhere around there. And again, these bear market targets are not all necessarily going to happen in 2022. What I would like to see is minimum us filling the gap at 400, not just testing 410, but getting down to 400, actually testing it and seeing what's going to happen. And if we hit 380s and then get the Powell put, that is where I would like to get back in, or on a weekly closing basis back above the 50 MA. Moving forward to next section here, again, this tells us that if the wheels are already in motion and we are truly bearish, we're not going to revisit the all-time highs. And that 50 MA is 1,000 points lower on the monthly. So what does that tell you? If we're sitting here at about, what is it right now on SPX? So on SPX right now, we're trading at about 43.84, almost where we were when I recorded this video, which means we got about 400 points in upside and 1,000 points in downside. That is not a good risk reward for me. I'm not interested in buying that. Also, if we're going to be hearing that the Fed is going to be reducing their balance sheet, you should not be fighting them. So one more time, why this happens as a revision to what we talked about in the bear market of 2022 explained is that in 2008, they increased. So again, we got a 2.5 years of expansion here, 25% higher. So over the course of 2.5 years, they increased their balance sheet by roughly 25%. And that's cut off at the top here, but it should say the same thing, right? About 2.5 years later, and we expanded the balance sheet by about 25%. So after they stopped expanding it, we just went sideways. And that's what I think we're going to do here. They want to reduce, but as we noted before, who is going to buy this? I don't know. I don't know. They don't want to buy it. That's why the reverse repos are so large, almost 2 trillion per day now. Why? Because no one wants this. They just want to get out. And again, just to this might be complicated for people, but I've gone back through and explained this in the other video. We're going to look here at Japan, where we got 1, 2, 3, 4 lower highs, right? 3 lower highs, sorry. So we got 4 tops, we got 3 lower highs. And once we got down to the lower bound, which is 0, we dead cat bounce once and then never look back. Now let's look at America. 1, 2, 3, 4, 3 lower highs. We're probably going to get 1 more rate advance, and then that's going to be it. And if you're confused right now, let me explain to you one thing. So the reason why this matters is because, as we noted before, if the Fed is not going to be able to run off their balance sheet, they're going to have to get aggressive on rate hikes. Why? Inflation's not going anywhere. With China now going to, again, zero bad word, again, virus, that's going to probably add supply chain constraints. What does that mean? Inflation's going to go up. And oil, which is a large part of the CPI, is going up. It's closing over 100. So there's no signs inflation is going to cool. I think it's going to keep rocketing higher, and it's going to be harder for us to overcome it. All right, now let's have a look at SPY and a little bit more of a deep dive. So let's go over here to SPY. Let's look at our higher time frame chart. So the first one we got here is going to be the monthly chart. The monthly chart here is going to be telling me whether or not we are going to be getting any upside as we open up the new month into the State of the Union and any higher. So we have very small upper wicks, which means there's not a lot of buying. What do we got? We got selling and buying the dip. So we got 3 massive lower wicks here, but the volume is not really all that high. It's roughly on par with previous months, resting at about 2 billion per month. So I don't know. The 438 level is going to be huge for me as we close and open up this next month. Why? It's basically going back to our previous base right here where we had the close and the open. That's roughly where we are right now too. Looking at the weekly chart, this is an impressive snapback. So what I'm looking at here is a falling wedge where we see the white line and the blue line meet, and that is where we bounced off of a perfect bounce. The volume looks okay, but it is not enough for me to say that that is capitulation. This right here would be the capitulation week where we ultimately went and formed a lower low. It's got a massive hammer. It's just below the 50 MA, so we pretty much have to start advancing from here. On the daily chart, again, from low to high, we have more than a 6% rally, 6.6%. Truly incredible pump. The volume is notable off the low, but the follow-through volume is not all that strong, which just means that people stopped fighting it. All right, what do we have here as well? Well, we got a big downtrend here. This right here is going to be Wednesday, which is going to be at, again, the day that Jerome Powell is going to be speaking. And what is that going to be? It's going to be a new monthly chart. So if we are below 438, 439 after Jerome, it pretty much means that we got a negative reaction to Joe Biden and Jerome on day 1. Then we got day 2. So that 438, 439 area is huge for me. It's also the October gap here. So we can look back and see that we got this October gap right here, and the low is 438.58. Also note the white arrow here, which goes back to our February 18th high, which is 486.66. So if we stall out below 440, you know the reason why. Moving forward to the hourly chart. Looking here at the hourly chart, what we can notice that Our impulse move is complete. And what that means is that we have a huge, huge, huge move higher. We're still technically trending down. We have our megaphone here. And the test for me is going to be basically right here. We can note here that at 4 o'clock on Monday, it's roughly 440. So if we're going to break through that daily level and we're going to continue higher, the hourly chart cannot afford to stall out. It has to pump again. It has to move off the 50 and curl up closer to that 200 hourly average, which is here at about 4,434. That's it for QQQ. So let's move back here and have a look at the 200 DMA and the 50 weekly moving average as we noted before. So again, where are we? Well, we're currently below both. So anything right now is still a dead cat bounce for me. Now let's have a look at the ETFs and note that same thing, whether we are above or below the 50 weekly moving average. So let's have a look here at these charts. Let's start off here by looking at XLF. And here is where there's going to be a Dragonfly Doji as well. So massive Dragonfly Doji. It is resting right on the key area. And what's important for me is going to be what will happen as we open up the new candle. If this is going to be a bullish impulse, meaning that we're going this Dragonfly Doji is going to turn into a bull move, we should blow through this previous top here. Sorry, the downtrend at about 40, which means we should blow through $40 and advance towards all-time highs. Next thing we're going to look at is going to be XLV. And XLV is important because we can note that we actually engulfed the whole previous bar, and XLV appears like it is a leader right now. So XLV looks pretty strong. It's got a huge, huge, huge candle. Moving forward to XLE or energy. If we have oil shocks and people are thinking that we've hit peak oil, you got to tell XLE. Wow, it closed up 1.2%. Massive hammer, and it actually saved 68.88 to the cent. Bounced perfectly off 65 as well. So I think this thing is ready for more. One of the chart that I find particularly notable that we talked about before is XLE versus TNX, so the 10-year Treasury note. We can note here that, again, 20 is going to signify 2% on the 10-year note, and it's advancing and trying to clear that 2% area, just like XLE was. What did XLE do? It butted up against it, backtested, then blew higher. So I believe the TNX is ready to explode higher as well. Moving forward to DIA or the Dow Jones, we can note here that we got our massive flush in volume. And now Dragonfly Doji, maybe a little bit of a hammer. We're still in a downtrend. Opening up flat for this next week will break that downtrend. But then we have to also break above the 50 weekly, which is going to be at about roughly 350. So the low volume tells me that no one's really fighting this move. And most of the volume actually got shooken out in the previous week. IWM or the Russell. Now here we can note that again, we got capitulation red volume and soft volume to follow through here. We're still channeling lower, massive hammer right on the downtrend, looks similar to the DIA, but it is way below the 50 weekly at 221. We got to rally by 10% to claim that area, and I don't know if it's going to do it. Last one I want to look at, a couple more here I want to look at actually is going to be ARK. So looking here at ARK. It's closing up by nearly 5%. If we're truly going to reverse, this one should be leading, and it is right now. It's up by 4.6%. So we saved the green line barely, and we should be able to what? We should be able to at least go sideways and break this downtrend if we're truly bullish. If we're going to power up, we should be able to blow through that 200 weekly moving average at about $74. So there should be an explosive move higher, talking 10%. Moving forward to NYSE. Here on the NYSE, massive Dragonfly Doji. Again, this is the NYSE, which is the composite of 2,000 stocks. And we can note here that they're closing out basically unchanged, closing up by 22 basis points or 0.22%. Next one we're going to look at here is going to be RSP. And as I noted before on SPY, if QQQ and the $1 trillion company are still the leaders, we need them to advance because right now we're getting some clues that equal weight S&P 500 is outperforming S&P and QQQ. So what does this mean? It means that we're potentially getting a new leadership mix. All right, moving forward. A couple more here. We got the VIX. So the VIX here, again, it is trying to bull break. We're not able to actually close and hold this $29 area, but it's trying really hard. It's technically breaking out, but it's not confirmed it yet. Next one for me to look at is going to be BTC versus gold. So let's have a look at BTC now, NYXBT. So here, what do we have? Well, we're trending down. We got an absolute downtrend now, dead cat bounce. And right now we're below 40K. It did briefly get above. We'll see whether or not we can actually hold this. And if we can get through 41.5, I'm looking for a move back up to the 50 weekly at roughly 47,000. Notable here that we are red on the week for Bitcoin. And as we shift over here to gold, gold is breaking bullish, even with the slam back down to close the week out. We're up by almost 1%, and we're technically closing above and back testing 1870, which is the bull break area from our IHS. Also looking here at the monthly chart, it tells us that we are resting right here on 1912. Why is that level important? Because as we look back to 2011, the high here is what? 1912.10. So what are we doing? We're closing this week out above the second previous all-time high month. After that, we got roughly 1921, and then we're off to the races. We've already price discovered above that. So if we hold into what? Monday, which is the monthly close, and we advance again, we're probably going to break 2000 and not look back. So gold versus BTC give me a huge, huge, huge clue. I would also note that things like wheat and corn, we did have a limit down into the move on Friday. So the tension between Russia and Ukraine has been largely seen in gold versus Bitcoin, and then commodities like wheat, which is a large export from Ukraine and from Russia, give us a clue. So that's what I'm looking at here. Moving forward, we got some options here, but I forgot I want to go through one more thing first. So now we looked at top down. What I want to look at here is whether or not the leaders of year to date are still going to be the leaders of tomorrow. We looked at the XLE chart, and we saw that it looked pretty powerful. So over here in the energy complex year to date, it's pretty bright green. We look at the leaders in the financials, also looking pretty bright green, and chips are red, software is red. And if we're going to see new leaders emerge, that's what we're going to look for here on a shorter time frame. So what do we see? Energy is mixed, other than Chevron. Banks are red. And what do we see starting to emerge with some green? Well, excluding Tesla and Apple, we've got Microsoft, Google, Facebook, and other companies starting to reemerge as leaders. So there is some potential here. All right, now let's get to those juicy options. Let's have a look and see what is happening on the options chains. I want to have a focus here, first of all, on the SPX March quarterly chain. And the reason why is because there is billions of dollars flowing here. What I want to point out are going to be two things. First thing I want to point out is going to be this put spread. So we got a put spread right here at about 45.20 to 4100. First thing that sticks out to me is that this open interest is unbelievably huge. Why? SPX is 10 times bigger than SPY. So 26,000 puts on SPX is the equivalent of 260,000 on SPY. And 44,000 or 45,000 is roughly 450,000 puts. I'd also note the premium here. They're worth 196 at the close here for the 45.10, and they lost half their value with no volume. Same thing here. Worth 190, lost 200 bucks in value. Why the hell aren't these guys closing out? It's way deep in the money. So I don't really understand this. 4.510 would be for the March quarterly expiry. I'd also note here that before, when we were talking about this person who was looking for a big bullish bet, there's other people who are looking for not just 44.60 or $200 million in premium. They're looking for more. As I look here, let me just zoom out a little bit. Let me zoom in a little bit. Looking at 45.50, 4,600, what I noticed that there's 10,000 in volume, 10,000 in volume, 12,000 in OI, 18,000 in OI. This looks like a call spread. So again, that's what that guy was literally buying. And this could be either people hedging it or someone else piggybacking on the trade. Why? He's only looking to March, what day was it? To March 25th. This is going to be for the quarterly expiry, which will be the following week. In terms of premium, the reason why this matters is because the 45.50, 4,600 call spreads are up by 100%, right? They're worth about 40 bucks, adding on about 17, roughly 100% higher. And $27 for the 4,600s, adding on about $13 in value. And over here on this side, on the put side, these are down by 50%. The OI value at the close was what? 1.4 billion, which means poof, bye-bye. We deleted over $1 billion in value. And over here, the volume for the call side is only 70 million. So it's not nothing, but it really, really, really diverges from the big numbers here. So what I want to move forward to now is going to be looking at the SPY weekly here. So Every chain next week is unbelievably busy, and then it drops off after we get to the March monthly expiry, which is going to be next Friday. So instead of looking through each individual chain here, I'm just going to talk about what is significant. Normally, I only have to screenshot the 16s, which means 8 strikes above and below. But for these ones here, I had to go beyond because it's just huge. There's volume all the way down for Monday. That's the next trading day. There's put flow all the way down to 415 again. And it's not small. It's 64,000. It is huge. So what's most notable to me here is that 435 is going to be that max pain, which is where we would close out the monthly candle on SPY if we're going to just hover where we are right now. So again, we're looking here to close out the monthly chart, and Monday's going to be the close. So this chain expiry is going to be for the monthly close for the month of February here. So looking out to here, we can note that we've got, month of February. So 435 would be max pain for me. There's lots of volume. There's lots of open interest. There's 444 to 460 calls. There's 430 to 425 volume for puts. And then we got put flow and volume and open interest all the way down to 415. Looking through to Wednesday, a little bit less busy, but oh my goodness. And last thing I want to point out here actually is just the premium. So looking here, and at the money call is worth about 350, which means for these guys to get their money back, we got to be at 440. For the puts to get their money back, we got to be 3 points lower as well. So that's going to be down at about 434. So it's big dollars. Why? Because the VIX is jacked up right now. All right, moving forward here too. The next week on Friday. So actually looking at Wednesday, so there's 435 to 440 call spreads, and then plus 450 naked, and then we got 436 down to 415 again. So again, what does this tell me? The reason why I think this is a trap is because the VIX got stomped. VIX got crushed, right? Again, got crushed, closing down basically flat, 9% red just on Friday. And these guys took advantage of it. They are buying like crazy. They're buying like crazy for Monday, for Wednesday, and for Friday. So I believe that post OPEX from February, these guys are reloading and they burnt the puts, and now they're going to let them go in the money. So looking forward to here, this is going to be the March 4th, which is going to be Friday now. So here we're going to be looking at 435 for max pain again. So it's really important. And as we have a look here, the at the money for 437 is worth about $6. That means we got to be well above 445 for these guys to get their money back. Where does that same number come into play? It's that $200 million bet we looked at. On the call sides, there is 100,000 there at 460. That looks like a stretch getting for Friday, but with these market swings, maybe we can get there if we get a perfect storm of Joe Biden and Jerome Powell both being bullish. Flipping forward to the put side, there is significant open interest and volume at 430, 425, 420, 415, 410, and even down to 400. So people are betting we're going to be back down there by Friday. Looking forward to the March monthly. What do we have? It is busy AF. It's got a bear tilt, in my opinion. Still a 435 max pain. And right, it's worth about $10 at the money for a put or a call. So we're likely going to see a big swing. 450 to 470. I'm just looking here again, looking at the call side. We got 450 up to about 470 in open interest. And there's a little bit of volume, but if we're really going to be moving higher into the month of March, why the fuck aren't these bulls buying any higher? They should be buying out of the money. They should be buying these huge leaps. They're not. Who's buying leaps? It's the bears, and they're buying a what? There's a lot of open interest. There's a lot of volume. So what do we note here? 430, 425, 420, 415, 410, 409. And then there's even more flow. Then we got 405, 400, 390, and 380. What's most notable to me are the strikes that have more than 100,000. So here we got 100,000 basically at 405, 400, and 380. And as we noted before, that Powell put, in my opinion, will be found at the 380 area, which is going to be flat, puking up all the gains from 2021. All right, moving forward here, the put-call ratio for the S&P 500. So again, what's interesting here is that closing out on Friday, the VIX is down 9%, and the put-call ratio for the S&P is down by 20%. Last week, we were up near 2, which means that for every call, there were 2 puts bought. So right now we're down to 1.3, which means there's still more put buying, but this is likely a little bit skewed with the expiry from Friday because we just absolutely power pumped higher. So right now, bears are giving up a little bit and the bulls are back to buying calls. All right, moving forward here, we got QQQ. This one's, I'm only looking at the 16s for this one here just because it's not nearly as busy. So here we're going to note that it's mostly muted and it's mostly at the money, right? You can see the spreads here, 434, 447. Here we got 444, 440. The premium's just really high and people just aren't really wanting to bet on QQQ. They want to bet on SPY. Wednesday here, very muted, not a single strike, more than 10,000 for volume or open interest. And then looking here out to Friday, 440, 345 to 350 spread. That's what I notice here for calls. There's nothing really on the put on the 16s. It's 340. Moving forward to QQQ March monthly. And this is where on previous weekend deep dives, we noted that there is big bear flow. So looking to here, what we can notice that we got 350, 345, and 340 put spread. So we got 98,000 at 350 put. We got 45,000 in OY at 345 and 79,000 down at 340. So with that said, that's the end of the video. So this one's a lot longer than previous ones. And the reason why I'm doing that is because I think that right now we are at a pivotal point on the charts. And I tried to only include what was relevant for the story this week because you're probably getting a little bit too much information overload. So what I would highly suggest is that you do one thing for this next week. Pick a side to trade on, understand what it means for you to have that pattern confirmed, and then don't deviate from it. As Jesse Livermore told us last week and the week before, the people who have success in the stock market understand where that pivotal point is, premeditate the best case scenario, the worst case scenario, and the surprise. And when they get the early confirmation, they do not hesitate to pull the trigger. If you're hesitating, you're not properly prepared. If you're going to flip-flop bear and bull, be prepared to lose your ass because it's going to be a very tough week. And it's probably best to sit on the sidelines and wait for the confirmation, bullish or bearish. Wish all the best of luck. And if you want to know the key dates for this next week, have a look at the video that's going to queue up here in a moment. And we will see you this next week. Thank you so much. Thank you so much for watching, and we'll see you in the next video.